Thank you very much, Professor Kydland. Our first reactor for this afternoon is the Governor of the Central Bank of the Philippines. As Governor, he is also either chair or a member of a number of government agencies, such as the Anti-Money Laundering Council, the Philippine International Convention Center, the Capital Market Development Council, PhilExport Board of Trustees, and Philippine Deposit Insurance Corporation, to name a few. He also represents the country in various international and regional organizations, including the Executive Meeting of East Asia and the Pacific, ASEAN and ASEAN Plus 3, Southeast Asia Central Banks, Center for Latin American Monetary Studies, and the Asia-Pacific Economic Cooperation. He also served as alternate executive director of the International Monetary Fund in Washington, D.C. in the 1990s. May I now invite Governor Amando M. Tetanco, Jr. to give his reaction.
Thank you very much. Senator Legarda, Professor Kydland, AIM Chairman Joy Quisha, Mr. Sisip, Mr. Morowitz, Dr. De Ocampo, AIM President Estrada, my colleagues at the BSP, special guests, Dean Liguanan, ladies and gentlemen, good afternoon. It is a pleasure to join you on this occasion. But before I proceed, I'd like to congratulate the International Peace Foundation and its partners for the success of the event, or the event series Bridges, Dialogues Towards a Culture of Peace. On behalf of the Bangko Sentral ng Pilipinas, I would like to thank the Foundation for inviting us to be a part of this worthy and noble undertaking. I would also like to congratulate Professor Kydland for a highly enlightening discussion on a subject that is front and center in the minds of policymakers. I particularly appreciated how deftly your influential work of time inconsistency in economic policy, many in close collaboration with Professor Edward Prescott, has been braided into the ambit of peace and economic development. This afternoon, allow me to home in on specific areas in your presentation that are relevant to the institution that I represent. Professor Kydland, together with Edward Prescott, has made fundamental contributions to two major areas of macroeconomic research. One, the design of public policy in such a way as to avoid what came to be known as the time consistency, or as some would put it, the time inconsistency problem. And two, the empirical methods available for gauging the impact of contemplated policy changes. As it turned out, both of these areas had their most profound impact in the field of monetary policy. It is in this respect that I would like to develop the outline of my discussion. First is on how the introduction of the time consistency issue and the consequent debate on the extent to which rules and discretion should figure in the conduct of economic policy have supported changes in the framework by which central banks formulate monetary policy. Second, I'd like to turn to the Philippines' experience in meeting the challenges posed by rapid financial innovation and globalization. Back in the 1960s and 1970s, central bankers, along with the majority of economists, thought that you could trade off a little bit more inflation if you wanted less unemployment. By the 1970s, however, the theoretical and empirical literature showed that this was not so. If monetary stimulus tried to push unemployment below the natural rate, the result would be accelerating inflationary expectations. Professors Kydland and Prescott presented this policy dilemma as one of the several examples in the general problem in economic policy making, the time inconsistency problem. In brief, a policymaker who cannot commit to a rule in advance, that is, who reserves to himself the right to introduce discretion in policy formulation, would be perceived by the public as facing an incentive to renege on its policy commitment. This creates a credibility gap, which results in both the public and the policy authorities' failure to achieve their goals. In the particular area of monetary policy, they showed that economic policymakers who cannot commit to a rule in advance often will conduct a policy that gives rise to high inflation despite their stated objective of low inflation. Kydland and Prescott considered the possibility of conducting monetary policy in terms of long-run rules, which can be difficult to change. In the early literature, the debate focused on rules, which prescribed how the central bank should react to major contingencies. A major drawback of such rules, however, is that they can restrict flexibility in policymaking in response to unexpected events. Kydland and Prescott, as well as much of the policy research then, shifted to an emphasis on the design of the institutional framework, that is, the institutions of policymaking. It is in this context that inflation targeting has been embraced by many central banks. Inflation targeting can be seen as an instance of what Svensson refers to as constrained discretion. Inflation targeting as a monetary policy framework introduces key features that constitute a disincentive for the central bank to stray away from the long-run objective of price stability. It is characterized by a pre-announcement of an inflation target, which creates possible costs in terms of credibility should the central bank be perceived by the public as being half-hearted in seeking to pursue the specific numerical goal of inflation. In our case, inflation targeting has reinforced our commitment to achieving price stability. A central bank's credibility and reputation, which some would say is the most important capital, more important even than its financial capital, rests on this commitment. Inflation targeting, therefore, can be considered what Professor Kydland has referred to earlier as a commitment mechanism, which needs to be in place in order to prevent the occurrence of time inconsistency in government policies. Recognizing its value in the achievement of price stability, the BSP, like other central banks, have adopted inflation targeting framework in the conduct of monetary policy. Allow me to briefly discuss its key features. First, it has a simple framework, which is basically the announcement of an explicit inflation target, in our case, 2 years in advance, that the BSP promises to achieve over a given period of time. Second, it reflects a comprehensive approach to policy by taking into consideration the widest set of available information about the economy. Third, it's forward-looking, as it recognizes that monetary policy actions affect inflation with a lag. This addresses Professor Kydland's message towards the end of his presentation that government policy has to be forward-looking. A forward-looking perspective is one of the basic tenets of the inflation targeting approach. It makes considerable use of indicators that have forward-looking content, such as business cycle trends, early warning systems, and expectation surveys, as well as financial market indicators. Fourth, transparency and effective communication are integral to the inflation targeting framework. This is because the Bangko Sentral needs to be accountable for its policy actions and decisions. Indeed, the de jure and de facto independence of the Bangko Sentral presupposes accountability. It is the quid pro quo for delegating the responsibility of promoting price stability to the central bank. Accountability carries with it the need to be transparent and to clearly convey to the market the reasons for policy decisions and actions. The broad aim is to make monetary policy easier for the public to appreciate and enable them to better monitor the BSP's commitment to the inflation target. thus helping in anchoring inflation expectations and in encouraging informed debate on monetary policy issues. In direct relation to the theme of economic development, inflation targeting as an institutional framework has been found to have contributed to the moderation of inflation and output fluctuations. There is a growing body of evidence showing that policies that moderated inflation has helped promote output stabilization, economic growth, and efficient resource allocation in the long run. This is because these policies lay the underpinnings for both wealth creation and wealth preservation, as economic agents better able to make informed consumption and investment decisions. The Asian Development Bank, for instance, attributed the region's vibrant economic performance to better economic policies and stronger institutional frameworks as a result of reform efforts pursued in the post-Asian crisis period. Chairman Bernanke also emphasized the role of monetary policy in helping to reduce macroeconomic volatility. In particular, he postulated that monetary policies that moderated inflation could, 1, help stabilize the structure of the economy, 2, affect the size and frequency of shocks hitting the economy, 3, change the sensitivity of pricing and other economic decisions to exogenous shocks, and 4, stabilize inflation expectations, which by themselves can be an independent source of economic volatility. In this presentation, Professor Kydland notes how rapid innovative activity and technological change have been major driving forces that propel economic growth. Two factors that have figured prominently in this process are financial innovation and globalization. Globalization can have a salutary impact on economic growth. Greater economic integration provides incentives for economic agents to increase their competitiveness and flexibility and reduce inefficiencies. Kenneth Rogoff et al. Looked at the effects of financial globalization on developing countries and found some evidence that countries have derived benefits from financial integration in terms of both higher growth and macroeconomic stability once they have crossed a certain threshold. This threshold is dependent on an array of factors that relate to the soundness of their macroeconomic policies and the quality of social and economic institutions, as well as the depth of the financial system. This analysis suggests that the benefits of globalization could best be extracted with sound policies, a stable macroeconomic framework, and good institutions. As a central banker, this message resonates strongly. Responsible monetary policies as well as a well-functioning financial system are key to ensuring that the benefits from globalization are maximized and that the economy is well prepared to meet the challenges. The primary objective of the monetary policy of the BSP is to promote price stability conducive to growth. An environment of stable prices supports growth because it allows households and businesses to plan ahead and arrive at better informed decisions relative to their consumption, investment, savings, and production needs. Furthermore, the BSP's commitment to price stability supports a more equitable distribution of the country's wealth and resources. We are mindful that high inflation hurts the poor most or more than any segment of society, as they do not have adequate assets that serve as hedges against inflation. At the same time, the BSP also endeavors to maintain the soundness of the financial system. With growing global financial integration coupled with financial innovation, as well as what we have recently seen as a breakdown in risk management systems of financial institutions, the transmission of financial crisis or contagion in recent years has become more rapid. The costly financial crisis of the late 90s have called for the institutional reforms and safety nets in order to better cope and withstand financial disruptions. In this regard, the BSP has adopted reforms in the banking system, including mandating banks to conform with IAS, IFRS, or the new international accounting standards. We have also beefed up governance requirements for banks by implementing the fit and proper rule as a standard for directors and senior officers. Furthermore, we have instituted improvements in our regulatory and supervisory frameworks to effectively manage risks inherent in today's highly complex financial environment and avoid systemic disturbances, including the adoption of new risk-based capital requirements of Basel II, starting July 2007. Indeed, the central bank has a role in maintaining stability in both the monetary environment as well as the financial markets, two pillars that help ensure the economy stays on a path of sustained economic growth. Let me digress here a little bit. Relating to stability in the economy, it would be interesting to find out the good professor's views on the central bank's role in resolving issues such as the adverse impact of the subprime problem in the U.S. on the financial markets as well as on the real sector. The recent movements in the financial markets stemming from subprime woes, I believe, highlight the fact that the financial systems do look to the central bank, in this case the Fed and other major central banks, as anchor during situations of financial volatility. Issues such as the role of the central bank as a lender of last resort and containment of moral hazard. Perhaps later on, Professor Kydland could provide us his insights on this particular issue. In addition to its discharge of its primary mandate, the BSP likewise pursues programs that aim to promote broad-based growth and uplift social welfare, including of those who are marginalized and who are currently outside the economic mainstream. One of our flagship advocacies is the promotion of microfinance. Microfinance activities provide the country's enterprising poor access to a broad range of financial services, such as deposits, loans, payment services, money transfers, and insurance. The number of banks providing microfinance services has increased over the years, while greater involvement by large commercial banks in microfinance activities has been noted. We have also continued to promote financial learning, including among overseas Filipinos. More specifically, the BSP has taken a proactive stance in embarking on a consumer education program that aims to improve the basic financial literacy of the public. In 2007, we initiated the Regional Economic and Financial Learning Centers project aimed at establishing libraries, statistical and learning centers for the regional economic and financial learning centers, as well as building skills and capabilities of regional centers' staff members. Likewise, the BSP continued its public information campaigns outside Metro Manila in line with efforts to enhance public awareness of the role of the BSP in the country's economic development and to further enhance the transparency of monetary policy. The professor's research has had important implications in the ability of governments to implement credible and sound economic policies. His work has profoundly influenced the practice of economic policy in general and monetary policy in particular. And today, we learned the broader implications of his contributions to economic and social development. The BSP likewise recognizes how economic underdevelopment comes in the way of lasting peace. This is why the Bangko Sentral is steadfastly committed to being an agent that promotes and preserves macroeconomic stability through the disciplined conduct of monetary policy, through the prudent oversight of the health of the banking system, and through the pursuit of advocacies that are supportive of broad-based and participatory economic development. Thank you and good day.
Thank you, Governor Tatanco. Our other reactor is an authority in the field of global finance and economic development. He was Secretary of Finance from 1994 to 1998. In 1995, he was named Finance Minister of the Year by Euromoney magazine. the first Filipino and the first ASEAN finance minister to achieve this recognition. He is the immediate past president of the Asian Institute of Management. Now a member of the AIM Board of Trustees, he is also presently chair of the Board of Advisors of the RFO Center for Public Finance and Regional Economic Cooperation, which has recently been designated as an ADB Regional Knowledge Hub. May I invite Dr. Roberto F. De Ocampo to deliver his reaction.
It is a rare opportunity to be able to be asked to react to a Nobel laureate. Being a dabbler economist myself, I find it a great privilege to be asked to react to an icon in international economics. But in order to reduce the risk of embarrassing myself, I not only tried my best to listen as intently as possible, but I did a bit of reading on some of the major works and theories of Professor Kydland. Let me discuss two major ideas that the professor had propounded, namely total factor productivity and the problem of credibility. From my understanding, total factor productivity is an index of all factors other than labor and capital, not explicitly accounted for, but which contribute to the generation of output. These include, among others, monetary shocks and actions of the political party in power, climate changes like El Niño and global warming, a firm's managerial capabilities, organizational competence, research and development, and diffusion of technology. The latter is regarded as the biggest subsection of TFP, or total factor productivity. Some see total factor productivity as the real driver of growth within an economy, and some studies reveal that while labor and investment are important contributors, total factor productivity may account for up to 60% of growth within economies. Various observers describe today's global economy as one in transition to a knowledge economy, that is, an interconnected, globalized economy where knowledge resources such as know-how, expertise, creativity, and intellectual property are more critical than other economic resources such as labor and capital. In the knowledge economy, three major drivers occur which boost competitive advantage. One, knowledge is what we buy, sell, and do. Two, intellectual capital is the new wealth. And three, knowledge productivity is the biggest challenge. The essence of the first characteristic of the knowledge economy is that the economic activities have shifted from brawn to brain, or from people working with their hands to people working with their heads, from tangible resources like brick and mortar to intangible resources like knowledge. The second pillar of the knowledge economy is a logical consequence of the first. It stresses the shift from financial and physical assets in the industrial economy towards knowledge assets or intellectual capital in the knowledge economy. Intellectual capital refers to non-monetary and non-physical resources. The concept of intellectual capital is based on the belief that the main resources for building competitive advantage are intangible resources. For example, the value of an Intel dual-core processor or Nike running shoe does not lie in the cost price of the components or materials used to assemble the product, but in the knowledge and skills of the people who designed or developed the product and the marketing power of the companies that sell the products. These are all intangible assets or intellectual capital. The third pillar is knowledge productivity. If one accepts as true that knowledge has become our main source of relative advantage and intellectual capital is the new wealth, then the process of transforming this resource into wealth has become the new challenge. Thus, as the productivity of knowledge will be the determining factor in the knowledge economy, the main responsibility of today's management is to make knowledge productive. Moreover, not only is the main source of production knowledge and the tools of production brains owned by the employees, but the biggest challenge in the knowledge economy is the productivity of the knowledge worker. Notably, in light of all this, Peter Drucker once proclaimed that the knowledge worker productivity is the biggest challenge of the 21st century for management. However, despite all this, I do agree with the professor that TFP is a limited measure. And as you mentioned in your paper on Argentina's gap puzzle, you reinforce that. And as most studies I've come across suggest that the theoretical problems underlying the notion of total factor productivity are so significant that the whole concept might even need to be somewhat reviewed. The most glaring point being the so-called attribution problem, meaning what in a total productivity is the combination or proportion that you would assign to the factors that lead to that particular overall total productivity. Now, because of this, I would like to focus now on your second point, which is the problem of credibility. As mentioned in your discussion on time consistency of economic policy and the driving forces behind business cycles, forward-looking governments make plans and policy decisions based on assumptions and known variables. As such, sequential policy making may be limited by credibility constraints, giving rise to the problem of credibility in the eyes of the public and business and industry included. When government opts to change its policies, it practices discretionary planning. This, according to the professor, results in lower welfare than the outcome wherein government can commit. Well, hard to disagree with, and I fully agree with the professor's observations when he looks at the contrasting styles between Argentina and Ireland. The lack of investor confidence in Argentina's constant devaluation, government defaults, corruption, freezing of domestic prices for utilities, and renegotiation of contracts with concessionaires led to a credibility problem. Sounds familiar? Argentina had hit hyperinflation in 1989 with an annual rate of over 3,000%. And to combat the crisis, government embarked on trade liberalization, deregulation, and privatization. However, because of its international debt obligations and government's continued high spending and corruption, tax evasion, and money laundering, investor confidence in the region spiraled, and all these factors contributed to Argentina's plummet into a recession. In the case of Ireland, the country experienced increased inflation due mainly to a rapid rise of unemployment, massive foreign borrowings for current spending, and an overvalued currency, coupled with globally stagnant economic development in the mid-70s. But they went into a transformation strategy characterized by tax cuts, welfare reform, reduction in government spending as a percentage of GDP, increased competition, incentives for the private sector and for foreign investments, a strategy which has been central to the positive economic surge of Ireland and continues to be followed, if you want to talk about consistency, by succeeding administrations. In short, Ireland's strategy was the positioning of the private sector as the main engine of growth. Thus, from being one of the poorest countries in Europe 20 years ago, Ireland now stands as one of the richest in the world. The Philippines looks like it shares closer attributes with Argentina than Ireland. Let me provide you some interesting statistics. In the Growth Competitiveness Index, which is composed of three indices: Technology Index, Public Institutions Index, and Macroeconomic Environment Index. How do we rank? Philippines in 2006 ranked 77. Argentina ranked 78. We beat them by one, huh? Ireland ranked 29. It's way up there. How about corruption perception index? Self-explanatory. Philippines, the higher your number, the more you're a champion of corruption. Philippines ranked 131. Argentina, 105. They beat us. And Ireland, 17. Human Development Index, which is a measure of a couple of things: long, healthy life, education, and a high standard of living. Philippines, 90. That's way down there. Argentina, actually, in 2007, 38. And Ireland, 5th. As my co-reactor is an expert on monetary policy, I'm not going to discuss this. In fact, monetary policy's consistency is probably one of the highlights of our governance in this country. Congratulations, Mr. Governor. But there have been problems of inconsistency and credibility. Let me just enumerate a few by citing certain paradigms. I cite paradigms because paradigms are supposed to be the bedrock, the consistent thing. As the professor says, the key upon which everything else is supposed to be measured and to be coherent. Let's take a few of our favorites, and I'm not citing just the present administration. This is across the board. Paradigm number one, democracy. Okay, we love it to death, right? We would rather have a country run like hell by Filipinos than like heaven by others. Well, I'm not going to go at length about the democracy issue. For that, you might want, I refer you to a number of speeches given by Chairman Washington CSIP, who has described the follies of our democratic system very effectively. Let me just say that on the credibility issue, the credibility of a democratic system relies upon the credibility of its election process and institutions. India, with more than 1 billion people, can get its votes counted in a day. It takes us more than a month and a half. And after that, we're not even sure if the outcome is credible. Number two, and again, this is a paradigm, since every government has consistently said this is it. We are pro-poor, all right? But in spite of our being pro-poor, the poor not only are still with us, there are more of them than ever before. And the gap between the rich and the poor is actually widening. Why is that? Partly because in spite of the consistency of saying you're pro-poor, the policies that are enunciated are either populist and therefore are given to handout type of approaches, or they are knee-jerk reactions in the interest of thinking you're serving the poor. Let me give you a recent example. Recently, for instance, there was a humongous cut in power rates. I think it went down to 1/3 of what they ought to be, in the interest of keeping the poor from being hurt, in spite of the fact that a great deal of the poor are on minimum bill. Okay, so we cut it down to just 1/3. What did it do? It ran up deficits like crazy on the fiscal position, and this, as the governor says, actually hurt the poor. But you see, the poor are not the first ones to understand the nuances of fiscal deficits. They certainly can understand when a power cut is made. But what's the result? We end up having to raise new taxes in order to cover that big deficit. And we called it reform. So when we introduced a reform VAT, some may actually argue that that was not reform, that was simply the financing of fiscal folly after the fact. Again, following from a paradigm of consistently being pro-poor. Third paradigm, The country's population is mostly agricultural, the labor force is in agriculture, and therefore we should pay attention to agriculture and free the farmer. Has it happened? Right now, there is a bill in Congress because the Land Reform Act is about to expire. And the question is, are they going to allow it to expire? Are they going to reform it? Or are they just going to renew it? And some are saying, well, let's renew it so that everybody can say we're still for land reform. But the land reform, as we have practiced it, has certainly focused only on ownership and not on productivity, so that productivity has gone down, and our ability to be globally competitive in agro-industry has not happened. Certainly the temptation to distribute land titles in the middle of a basketball court by politicians to all sorts of farmers who will then thank them and perhaps vote them again is very great. But that is not going to result in agricultural productivity that will result in global advantage. Let me give you a final paradigm so I don't go blabbing away too long. In order to help the poor, we need to create jobs, and in order to create jobs that are not created by domestic investors, we need foreign investments. How can you argue? Again, we ended up, however, with foreign investment acts that are replete with incentives, many of which no longer are necessary, and a lot of which are simply protectionist. As a result, you don't really generate the jobs you want to create, and once again, you threaten the fiscal position. Now there is a review of the Foreign Investments Act and a review of incentives, and one would hope that in spite of the fact that that paradigm is consistent, we will look at the way the policy itself is made to prosper. So in sum, does one say, therefore, that let's throw out all these paradigms because they've made a mess of things? No, not really. It's the policies after the paradigms that might have made a mess of things. But perhaps, learning from Ireland, we may need another, you might say, foundation for consistency that could encompass all these others. And to me, that may mean two things, listening to the professor. One is the philosophy of government as enabler rather than as provider. As long as the government is tempted to look like God Almighty to help everyone, as long as housing, for example, is interpreted to mean that government will provide everybody a house, as long as we think that the politician's role is to be thanked, then do expect these inconsistencies to happen. Government as enabler will bring the private sector as the main engine of growth. The second, of course, and the professor alluded to it very strongly, is for us to begin to look long-term. Of course, our problem is that our attention span tends to be between two elections, and that may not be long-term enough. Thank you very much, Professor, for your enlightenment, which I hope we can continue to apply to our own situation.
Thank you very much, Dr. De Ocampo. Ladies and gentlemen, the floor is now open for questions. We have microphones strategically located in the hall. And to facilitate the program flow, please limit your queries to one per person, and please identify yourself and your organization. Over there, Mr. Henry Grajeda of AIM. I will identify you for you.
Thank you. As a development scholar myself, I thought one of the most interesting slides was the one that you skipped. So instead of a question, could we ask you to please discuss that slide? Thank you.
Sounds like a fair request. Professor Kydland, would you care to, I believe that was the slide on income and wealth disparities across nations.
You might first make it. Yeah.
It was the second to the last.
So you already saw signs of that in the first three pictures I had. The disparities across nations in terms of income per capita are tremendous. Some of the poorest countries, income may be 1/60th of the income of the more well-to-do nations. And one may wonder what are the main reasons for that, and it turns out that almost always it results from bad policy of some sort. Within the framework I talked about, remember that I emphasized the importance of innovation, improving the technology, and so on. It's been highlighted also, emphasized also in the discussion, the very interesting discussion. I should say, by the way, that I learned a lot from the two discussants. I'm very glad you set up the program this way. I thought that was tremendous. Many policies restrict the set of technologies that can be used. And that can be for many reasons, and I don't think you'll allow me to go into, I agree this is an important slide. I don't think you'll allow me to spend a whole lecture on it, but let me just say that often it's the protection of vested interests that is behind. There are important interest groups in nations that happen to have the ear of the politicians. They realize they will lose in the short run with new technologies being adapted. That's very short-sighted. It's very short-sighted for a nation to go along with that. In the long run, everyone would benefit. It is true that there will be some who lose in the short run. In principle, the benefits to the nation are so great, potentially, that except for the difficulty of identifying the losers, in principle, it should be possible to provide some provision for those short-run losses. There's a lot of knowledge available in the world. This is perhaps one of the best or the most favorable implications of what we might call globalization. I think of an important aspect of globalization is that knowledge flows easily from one part of the world to other parts of the world. There are many things any country could learn from the rest of the world. They could adapt processes, they could adapt this knowledge to their country. Often that adaptation is not automatic, or it's hardly ever automatic. You usually need to combine the readily available knowledge with nation-specific innovative activity. But that's something that's the kind of activity I think any nation should engage in. And I'm talking broadly about these issues. There are clearly nations where even if the knowledge about what are the best seeds to use under the best circumstances, given the nature of the soil in that country, and so on, such issues are part of what I think about as knowledge that would contribute to making that nation more efficient, while it's embarking on a process of being a more highly industrialized nation. So, though, I believe there was, yeah. So I don't know if you're happy with that discussion of the missing page.
Okay, thank you, Professor Kydland. Yes, please.
Professor Kydland, as somebody who studied your models at extensive depth in graduate school, let me first say that it's a great pleasure and a privilege to have this opportunity to hear you listen and to hear you speak. My question pertains to the implications your work may have for the designs of institutions of fiscal policy. One of the lessons that we learned from the time inconsistency problem that you pointed out in the conduct of monetary policy was to design appropriate monetary institutions. The central bank independence is one example of that. I wonder what your work implies for the design of fiscal institutions, institutions of fiscal policy, which would automatically yield good fiscal outcomes year after year. What features you think help to attain that versus which don't? Thank you.
I think I don't have clear blueprints for what could be done. I think what the work implies is that it's even more important when in the context of fiscal institutions. It's even more important to think about them, to do research about them, and try to find solutions than it is in the case of monetary policy. You might say that we started with the easiest case. You make monetary policy as independent from the political process as you can. In the case of fiscal policy, it's hard to imagine that governments really want to give up the control of fiscal policy. I was at the conference in Costa Rica in end of October, arranged by the Copenhagen Consensus, to think about prioritizing what Latin America could do to improve development in their general region. And one of the things that was discussed was to create a government institution in charge of analyzing the effects of the fiscal policies being conducted and try to maintain the continuation across parties or across the leaders at a given point in time. It's clearly not so easy to do to make it work in practice, but I think any effort in that direction, or anything that today's smart, young and old economic researchers could come up with to try to find the right incentives in this situation would be very helpful. But all I can say is I think my work just emphasizes how important it is to really think hard about those issues.
Next question, please. Yes.
Professor Kydland, it's a small continuation to the previous question. I'm a student at AIN. Speaking about economic and fiscal reforms and deregulation, privatization in different countries, my question is it always a perceived loss of control on, say, public governance that prevents countries from adopting, say, forward-looking fiscal policies of tax cuts for multinational corporations, speaking about closed economies, maybe China up until a few years ago was really closed, and not to say it was not very successful, but is it perceived loss of public governance? Is that one of the main reasons that prevents such economies from opening up? Thanks.
I haven't really studied the different nations close enough or broadly enough to answer the question so definitively. Much of what I know applies to particular regions, and there's no doubt that I know more about the region of Latin America than about any other region. All of South America and Middle America. Some of what I know I've learned from others. There's a very interesting article you may want to take a look at. It was published in the Journal of Macroeconomics 2005. The title is Latin America in the Rear View Mirror. So the four authors, and one of them is Lee Ohanian, a well-known macroeconomist. Another is James Smits, and two more whose names escape me at the moment. They look at Latin America over the past 100 years. They document how strongly it's fallen behind Eastern Asia, as well as Europe and North America. And then they provide a number of examples for different countries of where either the competitiveness was reduced or increased, and they show data for the effect it had, either in the case of increased competitiveness, how the efficiency started to rise domestically right away, or the opposite, if competitiveness was reduced. And it could be through increases in tariffs or quotas, or there are many ways it can be done, or reductions of monopolies, etc. So what I know about Latin America, at least, suggests that those are important ways in which nations are prevented from growing the way they have the potential. Latin America should have the potential to grow as fast as nations that are otherwise similar in many ways, such as Spain, Italy, etc., but they just don't.
Okay, I believe we have time for one last question. Yes, please.
I was listening if a possibility of another factor that can be added, which is structural policy. Is it possible for us to discuss in our context of globalization and time consistency to step back and ask the question, is the system of government a factor in the discussion of global fiscal development, which you have discussed? Asking same question, which will have the same answer. Will a decentralized form of government be more effective in handling the global forward-looking system of government? Thank you very much.
Well, you're asking difficult questions, and I think all I can say is those are issues that are heavily researched today. It took surprisingly long, in my opinion, to really, for researchers really to get down to the nitty-gritty of what it would mean or what it would take to overcome these problems of inconsistency over time. And I won't pretend that we understand it very, very well as yet. There are some broad outlines of what we understand, and some of them I think all three of us have touched upon. You bring up an interesting idea, and I know there are some people who are arguing in favor of greater decentralization, or in some cases even using as examples countries that have been split in two, say Czech Republic and Slovakia, or other such examples. In the United States is an example where much of the decision takes place statewide. Many decisions that really affect the environment facing businesses. And I suppose using the United States and some other countries as example, it does suggest that there's something to that idea.
Thank you, Professor Kydland. At this point, I'd like to call on the chairman of AIM, Mr. Jose Quisha, to deliver the closing remarks.
Distinguished guests, ladies and gentlemen, good afternoon. First, I would like to thank Professor Kydland for his very enlightening and thought-provoking discussion on economic development in the age of globalization. My thanks also to Governor Tatanco and Bobby De Ocampo for sharing their views on this issue. I agree with Professor Kydland that the keys to long-term growth and poverty reduction are sustained capital investments, technology, and forward-looking government policies. While the Philippines still has a lot to achieve in terms of improving incomes and reducing poverty, I believe we're moving in the right direction. Last year, Philippines' GDP grew 7.1%, the highest in 31 years, and the fifth consecutive year it has grown above or near 5%. More importantly, domestic capital investments are finally picking up, increasing by 9.3% after several years of stagnation. In terms of foreign direct investments, we've seen equity capital flow into business process outsourcing and mining, two rapidly growing industries that have contributed to the nation's development and have the potential for technology transfer. With improved local and foreign investments, we've seen the unemployment rate decline to 6.3% in October 2007 from 7.3% in the same period in 2006. We have to give credit to the Philippine government, particularly to the BSP, or the central bank, under the stewardship of Governor Tatanco, for having maintained consistent and credible fiscal and monetary policies to improve investor sentiment. I would say particularly on the monetary policies, these policies have resulted in price stability for the past 2-3 years, such that our inflation rate of 2.8% in 2007 was below the BSP's target of 4 to 5%. I think Governor Tatanco and the Monetary Board should be commended for that. Only a few years ago, there were concerns about an impending fiscal crisis, as investors were skeptical about the government's ability to handle a widening fiscal deficit and growing external debt. Since then, the government has enhanced its credibility by substantially improving its fiscal position and showing its commitment to fiscal reform. The debt-to-GDP ratio has gone down from 78.5% in 2004 to an estimated 59.4% in 2007. The BSP has also done a great job in maintaining a favorable business environment through its responsible and credible monetary policies. In the past, fluctuations in inflation and interest rates would make long-term business planning very difficult. Today, we're experiencing consistently low inflation and low interest rates, a situation that analysts expect will be sustainable. As long as our policymakers maintain consistent policies, I'm optimistic that investments will continue to spur economic growth and generate much-needed employment to reduce poverty. I'd like to thank Bobby De Ocampo, however, for his very frank and very candid remarks about the issues, the paradigms that he mentioned, and of course, the concerns that have been brought up with regard to fiscal policies. I think we should probably get Bobby to speak at a different forum and let him expound on his views, very interesting views. Before I end, I'd like to add that in the Philippines, a major contributor to long-term growth has been the remittances of overseas Filipino workers. These remittances were estimated at over $14 billion in 2007 and were a big reason why the Philippines sustained growth over the past years, despite weak capital investments. I don't know how remittances would fit into Professor Kydland's model. Perhaps a professor would consider doing a case study on the Philippines, similar to what he has done for Argentina. On behalf of the Institute, let me end by again thanking Professor Kydland and Mrs. Kydland for having accepted the invitation of the International Peace Foundation. And I also want to thank the International Peace Foundation for having facilitated this Bridges Dialogues Towards a Culture of Peace event series. Again, thank you to all of you for your participation today, particularly, of course, to our reactors, Governor Amando Tatanco and Dr. Bobby de Ocampo, and of course, our guest of honor and speaker, Professor Finn Kydland. Thank you and good day.
Thank you, Mr. Quisha. Mr. Quisha, may we request you to come back on stage for a souvenir photo? May we invite Mr. Sisip, Mrs. Kydland, Mr. Morovitz, and Dean Licuanan to join the group up on stage. Ladies and gentlemen, that concludes our program. Thank you, everyone, for participating in this event. We hope you can join us again in the next Bridges Dialogues Towards a Culture of Peace at AIM on March 5, 2008, featuring former World Bank President Mr. James Wolfenson.